Hey everyone, welcome back to Corporate Decoder. Today V.I.S.N just filed an 8K reporting a dividend and a director's departure. And I am seeing a story about returning cash to shareholders that has got a potential tax twist. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is making a significant cash distribution to its owners, but how that cash is taxed might not be what everyone expects. Alright, let's dive into this recent filing from Vistance Networks Incorporated. This is a current report that tells us about important events happening at the company. The report is dated the 6th of August 2026, but the earliest event it discusses happened on the 4th of August. So, things have been happening pretty quickly behind the scenes. The company itself is Vistance Networks Incorporated, and you might know them by their stock ticker V.I.S.N. They are incorporated in Delaware, and their main office is in Richardson, Texas. First up, there is a change in leadership. Joanne M. McGuire has decided to retire from the board of directors. This is effective immediately. The company is saying this decision to retire wasn't due to any disagreements with the company or its management, which is good to hear. With her departure, the size of the board has been reduced to 7 members. Thomas J. Manning, who is already on the board, has been appointed to the Nominating and Corporate Governance Committee. This committee is pretty important as it is responsible for things like selecting new directors and making sure the company is run well. Now, let's get to the part that is likely to get the most attention. A special cash distribution. On the 6th of August 2026, Vistance Networks announced in a press release that its board of directors has declared a one-time special cash distribution, which they're calling the special distribution. This is a pretty substantial amount, $5 per S-share. So if you own 100 shares, that is $500 cash hitting your account. The payment date is the 27th of August, and you need to be a shareholder of record by the 17th of August to receive it. This part here is interesting because it triggers a specific Nasdaq rule. Since this $5 distribution is a big chunk, more than 25% of the company's stock value, the ex-dividend date is set for the 28th of August. The ex-dividend date is the day when a stock starts trading without the value of the upcoming dividend. So, if you buy the stock on or after the 28th of August, you won't get this special payment. Here is where things get a bit more complex, and it is really important for shareholders to understand. The company doesn't believe it has a significant amount of current or accumulated earnings and profits. Now, what does that mean in simpler terms? Earnings and profits, or EP, is a tax term that basically refers to the company's accumulated profits that are available to be distributed as dividends. Because they don't have much EP, the company expects this $5 per S-share distribution to be treated as a return of capital. This means that, for tax purposes, it will first reduce the cost basis of your shares. Think of your cost basis as what you originally paid for your stock. So if you paid $10 a share and you get $5 back as a return of capital, your new cost basis becomes $5. Any amount you receive after your cost basis is fully used up will then be taxed as a capital gain, which is generally taxed at a lower rate than ordinary income. However, they are also adding a very important disclaimer. This is based on currently available information and could change. This is the key caveat. If it turns out they actually do have more earnings and profits than they currently believe, then this distribution would be taxed as a regular dividend, which is typically taxed at a higher rate. This is why shareholders absolutely need to consult their own tax advisors. They also promised to file an IRS Form 8937 within 45 days after the distribution. This form officially reports the tax treatment of the distribution, so while they are giving an expectation now, the final word will be on that form. And they re-emphasize that this information is for general guidance only and not complete tax advice. Seriously, talk to your tax professional. Finally, the filing lists the exhibits. The main one here is Exhibit 99.1, which is the actual press release announcing this special distribution. There is also Exhibit 104, which is the cover page interactive data file, a standard piece for electronic filings. This press release is essentially the source document for the dividend announcement. Looking at the broader context for Vistance Networks Incorporated, or V.I.S.N, they are in the technology and communication equipment sector. Their market cap is around $2.8 billion with a P/E ratio of 18.2. And the stock has been trading in the $9 to $20 range over the past year, currently sitting around $12.35. Recent news on the 6th of August also mentions the Ruckus Network sale potentially funding this $5 payout, and there are also reports about their Q2 earnings, this special distribution of $5 per S-share. When considering the current stock price represents a significant cash return. If the stock is trading around, say, $12, that $5 is a massive immediate return, nearly 42%. This kind of payout often signals a company that is mature, perhaps has completed a major divestiture like the Ruckus Network sale mentioned in the news. and is looking to return excess capital to its shareholders. For tax purposes, the company's belief that they lack significant earnings and profits is key. If this holds true, it allows the distribution to be treated as a return of capital, which is generally more tax efficient for shareholders than a dividend, as it reduces the cost basis of their shares before any capital gains are realized. This is a smart move if their financial structure allows it, effectively giving shareholders cash while potentially deferring or reducing the immediate tax impact. However, the risk, as stated, is that if their earnings and profits are higher than anticipated, the tax treatment flips to a dividend, which could be a surprise for some investors. It highlights the importance of companies providing clear guidance on tax implications, and for shareholders to do their due diligence and consult with tax experts. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.